Good morning. Well, we are getting some highlights from that report, and the Fed in that report reiterating that it will remain patient on interest rate moves in light of softer global growth. The Fed also saying that the U.S. economic activity has been continuing at a solid pace, and it does expect GDP to come in at about a little under 3% last year. However, it did warn that the market's appetite for risk has decreased. It also brought up the recent trade tensions with China, saying that financial conditions tightened abroad, in part because of U.S. trade policy, and that growth concerns and U.S.-China trade tensions are part of what are putting markets on edge. The monetary policy report also addressed inflation and said that inflation has been restrained by recent declines in energy prices. That is something that has also been on the agenda here at the conference, the U.S. Monetary Policy Conference. We've heard from both New York Fed President John Williams as well as San Francisco Fed President Mary Daly, both saying that the Fed needs to be vigilant on both sides of its inflation target. Too low, too high, both are a potential risk. New York Fed President John Williams also saying that the Fed may have to adjust its framework for thinking about inflation because of how low it's been and for how long it has been that low. In the meantime, the balance sheet is something that also came up in the Fed's monetary policy report. It said the balance sheet declined by about $260 billion in around mid-2018. We hope to get some more information on the Fed's plans for ending the runoff on the balance sheet later on today. Back over to you.
Hey, Ylan, I got to know what you made of Williams saying that we got to stay vigilant against too low inflation expectations, and then this idea that the Phillips curve is alive and well.
Yeah, so it seems to be a little bit of conflicting information here. On one hand, Fed officials here so far have said that they do believe that this sort of bulwark of Fed policy does remain in place. They still believe it works, but they need to think about how it is working differently than before. There's been a lot of discussion about how the data that feeds into the Phillips curve may be different because of ways that employers are adjusting are compensating workers and how they're adjusting worker compensation these days. So there's a lot of questions about, are we using the right data in order to measure inflation, but that they do fundamentally believe that there is still a link between inflation and unemployment. The question is, if we don't have the best data, how do we make policy? And that's something they're trying to navigate through right now.